My name is John Polk, and I'll be presenting today. As you can see from that alphabet soup behind my name, I do have both a JD as well as an LLM, which is in taxation. But please keep in mind that nothing I say today should be considered legal advice. I'm an entity coach here with Traders Accounting, which means that I spend most of my time helping traders set up and operate business entities in order to help them save on taxes. And this really makes me the perfect person to talk to you today about how to escape from investor tax status. Now, as you're listening, there are a couple of things that we ask you to keep in mind. The first is that tax law does change constantly. We make every effort to keep this presentation as up-to-date as possible, but before you rely on the information that I present here, I do recommend consulting with a tax attorney or a tax accountant like Traders Accounting. The second thing we ask you to keep in mind is that Traders Accounting is not a law firm. We are an accounting firm, so none of the advice given here should be construed as legal advice. Now, Traders Accounting, for more than 17 years now, we've been working with all aspects of trading and taxation. This includes helping traders set up business entities to do their trading through, helping them with their tax preparation, both for their trading business entity as well as personal taxes, trust and estate taxes. We help traders with their monthly bookkeeping, tracking their expenses and income, help them with coaching to ensure they're operating those entities properly, and we also help traders with their retirement needs by setting up self-directing 401k plans and their estate planning needs through revocable living trusts. As you can see, we really try and live up to our motto, you trade and we do the rest. Now, if you'd like to find a little bit more about who we are and what we do, we invite you to check out our website at www.tradersaccounting.com. Give us a call at 855-334-7936. You can email us directly at ravenj@tradersaccounting.com. So today we're going to be talking about escaping from the investor tax status. And to get to that point, we're going to have to talk a little bit more about the basics and just what it is the IRS actually does. Now, the IRS has just one job, and that's to collect taxes, to take your money. And because their job is to take your money, and Congress has set up the rules so that the burden is on you to stop them. You have to file your taxes correctly. You have to keep your records properly, all in an effort to prevent the IRS from collecting taxes from you. Now, this is perfectly legal. Everyone does this, rich and poor alike, because nobody owes any more in taxes than the law demands. But the way the system works, the burden is placed on you to prevent the IRS from collecting any more in tax than you actually owe. And as a trader, you have a much tougher time of doing this than just about anyone else out there. And this is because in the eyes of the IRS, you are considered an investor. This is the default tax status. And you can only change this by taking affirmative steps, changing your methods of operation and how you carry out your trading activity. But currently, as an investor, you are paying more in taxes, you have complicated filing requirements, and have to deal with major tax issues that only affect investors and can cost you seriously when it comes time to file your taxes. At the basic level, the IRS defines investing as someone who typically buys and sells securities and expects to receive income from dividends, interest, or capital appreciation. The IRS also specifically says that investing is not a trade or business activity, which severely limits your ability to deduct expenses you have related to producing that income. And it doesn't matter what you call yourself. Now, the only thing that matters is how you're carrying out your activities. But the default status is investor, and we're going to walk through the effects being investor has on how you report income and your ability to deduct expenses related to producing that income. But most definitely, as an investor, the tax code is not your friend. It has effects on how you report the income you receive from your trading activities, and it affects your ability to deduct the expenses related to producing that income. We'll start with the investment side of things. And as an investor, there are really three types of gain that you can expect to see. There's capital gain and capital loss, which applies to stock and stock options. There's ordinary income gain and loss, which applies to trades with Forex. Then there's Section 1256 gain and loss, which applies to futures, some index options, some ETFs, transactions of that nature. And we'll start with the capital gains tax. And the capital gains tax applies to all of your capital assets. And just about everything you own and use for personal purposes, pleasure, or investment is considered to be a capital asset. And Congress has decided that they want to encourage the long-term holding of those capital assets. So as a result, anything you hold more than a year is subject to a lower tax rate, the long-term capital gains tax, which is either 0, 15, or 20% based on your overall income tax bracket. Anything you hold less than a year is considered short-term capital gain, and the income is taxed at whatever your ordinary income tax rate happens to be. When it comes time to report these on your tax return, you need to do so through Schedule D. And most tax preparers and most traders will simply rely on the 1099-B they receive from their broker in order to complete this schedule. Unfortunately, you just can't do this. Now, when you're filling out Schedule D, you're required to have quite a bit of information for every transaction. Name of the stock, number of shares, purchase price, sales price, date sold, and date purchased. Now, you're required to report this information, and the burden is on you to track it. The burden is not on your broker. And particularly if your broker isn't tracking, say, for example, what you paid for the stock, when you sell it in the future, that's going to cause a serious issue recognizing gain. But the burden is on you to keep adequate records for all of those transactions. And as you can imagine, it's pretty time-consuming with even a few transactions. But as you become more and more active as a trader, the time burden that associates with properly filing that Schedule D goes up and up, which either means more time spent for you filling out your return or more money spent getting that return prepared. And while the Schedule D is a headache on its own, as an investor, there are two more issues you have to worry about when it comes to your capital gains. The first is the wash sale rule. And a wash sale occurs whenever you sell a security at a loss, then within 30 days, either before or after the date of that sale, you purchase the same security or substantially similar one. And this rule does apply to stock options, and any options on the same underlying security is considered substantially similar for the purposes of the wash sale rule. But when a wash sale occurs, the loss on the initial sale is disallowed, and the basis of your replacement position is adjusted to carry that loss forward. To give you an idea of what this looks like, we've got the example of a trader who owns Microsoft at $25 a share. And at the end of the year, they go ahead and sell it, taking a loss of $2 per share. At the start of the next year, they get back into Microsoft. Now here, we have a wash sale. We have a loss, then within 30 days, before or after, a repurchase of that same position. So the loss is disallowed, and the basis of the replacement position is increased, carrying that loss forward. Now, as you can imagine, it's an incredibly big headache to track these transactions, especially across multiple accounts. But the main negative effect of the wash sale rule shows up exactly in this situation, where the wash sale occurs over the end of the year. Because for 2015, you had a loss of $2 per share, and you reported that on your return as a loss of $2 per share. But because of the wash sale, you're not allowed to deduct it. So instead, you end up with a lot more taxable income in 2015 and have to pay tax on essentially phantom income. And these wash sales can be triggered unexpectedly because trades in separate accounts can trigger wash sales. If you sell Microsoft in your TD account, then purchase Microsoft in your E-Trade account, that is still going to be a wash sale. And this is another reason why you can't just rely on that 1099 from your broker, because you're required to track wash sales over multiple accounts, and E-Trade is not tracking wash sales from TD, or vice versa. On top of this, wash sales can also be triggered by trades in your IRA. And so if you sell Microsoft at a loss in your TD account, then purchase it in your IRA within 30 days, that will trigger the wash sale rule, carrying that loss up into your IRA, where it's never going to give you a taxable benefit. And so these wash sales are pretty devastating from a tax-paying perspective. Because remember, when you have a wash sale, you've likely misreported your income for a previous year, particularly if your return wasn't filed properly. If you've misreported income, this means you have additional tax due for that year. And if that misreported income is a large enough number, there's the possible need to amend that previous tax return, which is an additional time and expense for you. And so you can see these wash sales really are a terrible thing. So the wash sale is one of the two main issues you face as an investor. The other is the $3,000 capital loss limitation. And this one is a little bit more straightforward. If you have capital losses, you can only deduct up to $3,000 against your taxable income from other sources in a given year. So let's say in 2015 you had ordinary income of $100,000 and a terrible trading year, a capital loss of $100,000. Most people would look at this and say, oh, you've made $100,000, you've lost $100,000. The year's a wash. Unfortunately, the IRS is not most people. They look at that capital loss and they apply the $1,000 capital loss limitation, leaving you with taxable income for 2015 of $97,000. So you still have to pay tax on $97,000 of income, even though you've lost $100,000 that year. The remaining capital loss is suspended and carried forward to future years. However, if you're stuck at that $3,000 per year, it's going to take you 32 years to write off that whole loss. But the $3,000 capital loss limitation and the wash sale rules both act together to really drive up investors' tax bills at the end of the year, because both of them can cause you to not recognize losses in the year in which you actually take them. Now that covers the effects on income for capital gains and capital losses. Now the next type of income we're going to talk about is Section 1256. And this applies to futures, broad-based index options, some ETFs, depending on what they're made up of, E-minis, etc. Really any sort of non-cash settled option. And with these types of contracts, the net income is taxed 60% as long-term capital gain, 40% as short-term capital gain, regardless of their holding period. This means that by default, Section 1256 contracts are already given an advantage tax rate. They're also much easier to report. You simply fill out Form 6781, list your broker, and the net gain or loss for the year. There's no need to keep the same level of detailed information as you would for stock and stock options. By default, these are also exempt from the effects of the wash sale rule, and they're considered mark-to-market at the end of the tax year. So if you have a 1256 contract that's open over the end of the year, it's considered sold on December 31st, and then as if you'd repurchased it on January 1st at a new cost basis. So the 1256 taxation is a little bit better than the standard capital gains, capital loss treatment. Then we've got the taxation of FOREX, which is taxed under Section 988. And by default, these are given capital gains, capital loss, by default, these are given ordinary income, ordinary loss treatment, which means that for FOREX gain, you're paying the same rate as you would with short-term capital gain. But with losses, if they're ordinary in nature, you're able to deduct them 100% against your income from other sources. On top of that, with FOREX contracts, on a trade-by-trade basis, you're able to elect them into the tax treatment for Section 1256 contracts. But this is not a universal election and needs to be made on a trade-by-trade basis when you open the position, preventing you from any sort of cherry-picking to get the preferential tax rate on gains versus losses. So as an investor, when it comes to reporting your income, you have to worry about the requirements of Schedule D, making sure you track all the appropriate information and get that filed correctly. You have to worry about keeping track of your wash sales and properly reporting those on your tax return. You have to worry about the possibility of that $3,000 capital loss limitation preventing you from writing off your trading losses. And you have to worry about making sure that any 1256 or 988 contracts are handled properly on your tax return. Already you can see, as an investor, the way you report income is pretty disadvantaged. But this is only one side of the coin. The other side is expenses. And as you spend more and more time developing your trading, spending more on education, spending more on computer equipment, your expenses are going to increase. So the question you need to be asking is, are those expenses deductible? And we've done an overview of all of our clients and found these areas are where they're spending money related to producing income from trading. Depreciation for computer equipment or furniture, the cost of using a personal vehicle to attend business functions, things like education, dues and subscriptions for platform and data fees, trading organizations, or periodicals, educational expenses for home study seminars and trade shows, repairs for their computer equipment, the cost of having an office, bank service charges, office supplies, software, telephone, internet, TV, professional fees such as tax preparation and accounting, then travel and entertainment, often for educational expenses. And so these are the areas where our clients are spending money on producing income from their trading activities. If the IRS views them as an investor, they're significantly limited in what they can deduct. Now, the IRS has specifically prohibited investors from deducting the vast majority of these expenses. Investors are only able to deduct expenses related to dues and subscriptions, the cost of having an external office space only, bank service charges, and professional fees for tax prep and accounting. All of these other expenses are specifically non-deductible for investors because investors cannot be a trade or a business. So as an investor, you cannot deduct the majority of expenses you're paying related to producing your income. On top of that, those few expenses you can deduct are subject to the 2% AGI threshold limitation, which means you can only deduct the portion of the expense that exceeds 2% of your AGI. I think you'll agree, as an investor, the tax code is most definitely not your friend, and investors pay more in taxes because you have to worry about the rules surrounding investor income, things like the wash sale rules and $3,000 capital loss limitation preventing you from deducting your losses. You have to worry about the fact that the IRS specifically prohibits you from deducting the vast majority of expenses you have related to producing that income. So as an investor, it's very important that you are working with a tax professional who knows traders' taxation, making sure that they're familiar with the wash sale rules and the deductions that are available to investors. And here at Traders Accounting, we do work with investors. We help them with their record keeping, tracking their expenses and income. We help them with the preparation of their tax returns. We help them with the calculation of wash sales across all their accounts. And we help them with consulting, talking to them about their situation and making sure they're not making any missteps when it comes to handling their trading. But this isn't really a great option. The better option is change how the IRS views you. And if you change your methods of operation, you can change how the IRS is going to tax you. You can do this by taking affirmative steps to change how you carry out your trading, and so the IRS will view you as a trading business. And once you've taken those steps, it has immediate and dramatic effects on how income is treated and your ability to deduct the expenses related to trading. A trading business is still subject to the same default rules when it comes to recognizing income from your trading activities. However, a trading business also has another option. It can make what's called the mark-to-market election and change how it handles the accounting for its trading activities. And this mark-to-market election is a change of the accounting method for your trading. And it converts all of your gain and loss from capital gain and loss into ordinary income and ordinary loss. So simply by making that mark-to-market election, you exempt yourself from the effects of the $3,000 capital loss limitation. Also, by making the mark-to-market election, you exempt yourself from the effects of the wash sale rule. So already, by making this mark-to-market election, you're removing the effects of the two main tax issues that investors have to deal with. Now, all trades that you have would then be mark-to-market at the end of the year. So much like futures, if you have anything open over the end of the year, it's considered sold as of December 31st, and then repurchased on January 1st with a new cost basis. And this mark-to-market election is incredibly beneficial to a trading business because, again, by making that mark-to-market election, you exempt yourself from the two main issues that face investors. And, of course, anything this beneficial to the taxpayer, the IRS puts some pretty strict rules on it, and you must make this properly in order for it to be effective. If you're making it for an existing trading business, then it needs to be made by the last unextended day to file your taxes for the previous tax year. However, if you're setting up a new trading business, you can make this mark-to-market election as part of creating that new entity, and then it would be effective from day one for your new trading business. Now, it's a very important point that the mark-to-market election is not mandatory for a trading business. If you're a trader that works with stock and stock options, the mark-to-market election is almost a no-brainer because it exempts you from the $3,000 capital loss limitation and it exempts you from the wash sale rules. And it does this while not changing how you pay tax on your income. But it's not great if you trade anything else because while the mark-to-market election can provide benefits to futures and Forex, it also changes your ability to have that special 1256 tax rate. So by using the mark-to-market election as a futures trader, that can actually hurt you from a tax perspective. It's also not great if you have a large personal capital loss carry forward, because by making that mark-to-market election, you're essentially converting your main future source of capital gain into ordinary income. But these are just things to think about when it comes to making that mark-to-market election. But this should highlight how important it is to speak with a professional when you're making this choice, to make sure that you're making the right decision when it comes to this election. And so on the income side of things, being viewed as a trading business offers you a lot more possibilities, and the ability to make that mark-to-market election is just hugely valuable. On the other side of things, by being viewed as a trading business, you're able to deduct any expense you pay related to trading. You also have the ability to deduct expenses related to operating that trading business. And so if you think back to my list from before, as a trading business, you're able to deduct every single one of these expenses: computer equipment, furniture, personal vehicle, student subscriptions, educational expense, equipment repairs, home office deduction, bank service charges, utilities, professional fees, travel, and entertainment. Any of these, if they're related to your trading business or operating your trading business, become 100% deductible. And our clients typically see between $7,000 and $35,000 per year based on these deductions. I want you to think about that for a second. That's $7,000 to $35,000 per year in deductions that come simply from converting your investing into a trading business in the eyes of the IRS. That's a hugely beneficial thing immediately. And as with anything hugely beneficial, the IRS puts some pretty strict rules on the record keeping you need to do in order to take those deductions. The first is that you'll need to have monthly bookkeeping. You need to be able to show the IRS how much you paid for those expenses and have a solid record in place so that if the IRS asks questions, you can simply report your monthly bookkeeping and that'll take care of things. The second requirement is a little bit more complex. And that's that you need to be able to show that you are qualified to take those deductions. Essentially, you need to operate in such a way that you are viewed as a trading business. And as an aside, when it comes to those expenses, you're not only able to deduct those expenses you pay moving forward, but you can also deduct expenses that you paid related to trading before you were trading business. And you can look back about 12 months and recapture any expense you paid in that time that's been related to trading. Up to $5,000 is taken as an immediate deduction, and then any excess is amortized and taken over the next 15 years. But again, this is only available to you once the IRS is viewing you as a trading business. So when it comes to qualifying as a trading business, the IRS looks at your trading activity, how you structure that trading activity, and how you carry things out on a monthly and yearly basis. But once they qualify you as a trading business, this opens up additional deductions as well as benefits that that trading business can give you. And the IRS calls this tax status the Trader in Securities tax status. And that's just what they call a trading business. So we turn to IRS Publication 550 to tell us what is qualified as a trading business. And IRS Publication 550 gives us 3 requirements to meet in order to be a trading business, and 3 tests they perform on your trading activity in order to decide if you've met those requirements. Now these tests take into account all of the trading that occurs under your Social Security number. So this is a perfect example of why we like using trading business entities for these trading businesses, because it can avoid a lot of the nasty commingling we see with trading businesses trying to be run out of a personal account. But so these 3 tests really take into account whether or not you are trading like a business would. Publication 550 is the special rules for traders in securities. And the 3 requirements you need to meet in order to qualify are: first, whether you seek to profit from daily market movements in the price of securities and not from dividends, interest, or capital appreciation. Second, your activity must be substantial. And third, you must carry on the activity with both continuity and regularity. So these are the 3 requirements for being viewed as a trading business. And the IRS gives us 3 tests to use in order to see if you've met those requirements. In order to determine if you're seeking to profit from daily changes in market price, they'll look at the typical holding periods for the securities that you buy and sell. In order to determine if your activity is substantial, they look at both the frequency and dollar amount for your trades throughout the year. In order to determine if you trade with continuity and regularity, they examine the amount of time that you devote to your trading. Unfortunately, this is all the IRS gives us. They don't tell us which holding periods are too short and which are too long. They don't give us a hard number of trades you need to have during the year, or a hard dollar value to reach. And they certainly don't give us a number of hours requirement in order to show that you're trading with continuity and regularity. So what we've done is examine the tax court cases, and based on the tax court cases, come up with 2 rules of thumb to see if you qualify as a trading business. First, a trading business is active on 80% of the available trading days throughout the year. Works out to about 200 days. Second, you place a trade on each day. Now clearly there's a little bit of overlap. If you trade 5 times on Monday and 0 times the rest of the week, that's okay. If you trade 20 times on Monday and skip the rest of the month, that's not going to be okay. But so long as you are active on 80% of the available trading days and place a trade on each of those days, so long as you trade while behaving like a business would, then the IRS will view you as a trading business, and you'll be able to take all of those deductions that we ran through earlier. Now when I say trade while behaving like a business, I'm sure you've all heard the advice that you need to trade like a business to succeed. Take emotion out of the equation, stick to your rules, things like that. But in this context, in the context of taxes, when I say trade while behaving like a business, I mean something entirely different. The first thing a business does is choose the right business entity structure for its circumstances. Then once the business has established that entity structure, they keep it compliant with any entity requirements. And they do this while keeping up with monthly bookkeeping. And you may notice this monthly bookkeeping coming up again and again. That's because we've seen this factor be so important in all the IRS cases. When they find monthly bookkeeping, they're much more likely to view a business as an actual business. If they find less frequent bookkeeping, it's a serious mark against that activity being considered a business. And so I'll say it again, that monthly bookkeeping is one of the most important things you can do to keep a trading business active in the eyes of the IRS. When it comes to selecting the right structure for your circumstances, you've got quite a few options. And all these options have upsides and downsides. You can even change your method or your entity structure once you've got things moving. But it may have tax consequences when you do, especially if you're moving out of a C or an S corporation. The simplest entity choice you can use is a Schedule C. And this is also known as a sole proprietorship, just a different name for the same tax status. Now I say it's the simplest because it's simply filling out an additional form with your individual tax return. You file a Schedule C, list all of your income on that schedule, list all of your expenses on that Schedule C, then list your trading income in the appropriate section of your return. Schedule D, Form 6781, or Form 4797, depending on what it is you're trading. Now this is the easiest to set up, and because of that, it does look like a pretty attractive option. However, there are some substantial downsides to using a Schedule C for trading. The biggest downside is that it increases your likelihood of audit. Now from a pure structural perspective, the IRS is about twice as likely to audit a Schedule C as it is to someone engaging in business in a formal business entity. But on top of that, a properly filed Schedule C for a trading business produces a Schedule C showing only expense and no income. And as you can imagine, when the IRS is looking at things, if they see you trying to operate a business with what looks like only expenses, this is going to raise some questions. And so the Schedule C trading business does get audited a lot more often. These businesses are also much harder to keep separate from your personal taxes because, well, they're part of your personal taxes. And so that Schedule C runs into a lot of issues with commingling. It's also impossible to deduct medical expenses through a Schedule C. Instead, you end up taking them through Schedule A on your personal return, where they're subject to a 10% AGI threshold limitation, which often phases out that benefit for the taxpayer. The LLC is a much better option and choice to use for the purposes of a trading business. And that's because LLCs act as pass-through entities, passing through income and expense through to the members of the LLC with the same character of gain and with no payroll tax due. And they're able to do this because they're a creation of state law, and so they get flexible treatment at the federal level while still being able to provide limited liabilities for all the members of that business. As I mentioned, LLCs are a creation of state law. And so at the federal level, the IRS chooses or lets you choose how you'd like it to be taxed. And this can be anywhere from a sole proprietorship to a partnership, an S corporation, or a C corporation. For the purposes of trading, we like to see at least 2 members in the LLC so that it can elect to have the partnership tax treatment. When your LLC is being taxed as a partnership, the profits have the same character of gain on your personal return as they would have inside the LLC. So if you're trading futures contracts in your LLC, that income flows through to you with that same lower split 60/40 tax rate. And they do this without any payroll tax being due. And I can't stress how much of a benefit that is, being able to deduct business expenses while taking your profits without paying payroll tax. It's saving you about 15% on all your profits. You can, of course, subject yourself to the payroll tax through your LLC, but you would only do that if you were looking to make retirement account contributions. Unless you actually take steps to change the character of your trading profits, if you're using an LLC, you will not pay payroll tax on them. Now, the LLC does have a lot of benefits, but it does have some downsides. And with an LLC, you cannot deduct medical expenses. Again, those get taken through Schedule A on your personal return, where they're subject to the 10% AGI threshold limitation. Members also pay tax on profits yearly, even if those profits are left in an entity. So you cannot use this trading LLC as a means to defer recognition of your income from trading. Even if you leave your trading profits in that LLC, you're still going to pay tax on your profits on a yearly basis. You also do need at least 2 members for the LLC to be effective. And for our trading LLCs, that second member is typically the trader's spouse. It can also be another friend, a family member, or a separate business entity like a C corporation or a trust. But unless you have 2 members in that LLC, it can't be treated as a partnership, and so won't have any of the tax benefits of using an LLC for trading. You can also trade through a corporation. And to be clear, this is a subchapter C corporation. The subchapter S corporation is a terrible option for a trading business. It ends up subjecting your profits to the payroll tax. And so we cannot stress enough, don't use an S corporation for trading. But for a C corporation, that is a possibility. And that's because the C corporation enables you to provide a lot of benefits to yourself and your family. And it is a complete standalone entity, so it does not need a second member to be effective and can actually act as the second member in your LLC. The corporation's benefits are pretty clear. It's the best entity to use if you'd like to pay you and your family a wage. Because it's the best entity to use to pay for a wage, it's also the best entity to use for making retirement account contributions on behalf of yourself and your family. Corporations also offer you the ability to deduct medical expenses on behalf of yourself and your dependents, something that no other structure can give you. Of course, these benefits are offset by the corporation's downsides. And the biggest downside is that it's tough to take profits out of a corporation without paying payroll tax on them. And again, those are about 15%. If you do manage to get the income out of the corporation without paying payroll taxes on it, without paying yourself a wage, then you end up with double taxation, where the income is subject to tax both at the corporate level and at the personal level. And the corporation also does pay its own taxes, often having quarterly tax filings due to keep up with its income tax responsibilities. Now, we've talked about the benefits and downsides of the corporation and LLC. Each of them do bring a lot to the table in terms of their benefits, but they each also have pretty substantial downsides. Now, it's possible to combine the corporation and the LLC in order to gain the benefits of both while ameliorating their weaknesses. And our accounting firm got together all of our creativity, and we came up with the name for this structure as the combination entity structure. This structure consists of a corporation that exists to provide benefits and pay expenses. The corporation is one of the members of an LLC set up just to trade. Now, the LLC generates income and passes just enough up into the corporation to provide for the medical benefits for yourself and your family, to pay your wage, and to make retirement account contributions on your behalf. The remainder of the income flows out to you through the LLC, where you receive it with no payroll tax due on those profits. So by using this structure, you really are able to receive the best of both worlds while protecting yourselves from the downsides of operating a corporation or an LLC. When it comes to filing as a trading business, using an entity is incredibly valuable because it helps provide a clear distinction between your business and your personal investing. By trading through a formal business entity, you're also making sure you have the lowest audit risk possible instead of trading through a Schedule C. And also by setting up a new entity, you're able to recapture and deduct your previously paid trading expenses, bring them into that new business, and allowing you to deduct them as soon as you start things up. Now once you've set things up, it is important, equally important in the eyes of the IRS, to keep that entity active and compliant with its requirements. The first is going to be the annual federal tax return. These are typically due in either March or April, depending on which sort of entity structure we're talking about. Your entity also has state tax returns for at least most states. Some states are a little bit more forgiving and will not have those state tax returns. The same applies to regular state reports, letting the Secretary of State know that you're still in business and if you've changed your address or any other contact information. In addition to these, the IRS expects you to keep up with monthly bookkeeping. And once you've done these 4 things, you're able to keep that entity active and so keep it a viable option for helping you save on taxes. And here at Traders Accounting, we specialize in working with traders, and we help traders with their monthly bookkeeping. We help them plan out and create the right entity structure for their circumstances. We help them with the tax return preparation for their business, as well as personal, trust and estate taxes. We help traders calculate their wash sales, or we help them make that mark-to-market election so they never have to calculate wash sales again. And we help them with consulting, helping them with any tax issues that arise with their business and making sure that everything is treated properly in the eyes of the IRS. Now, I've talked about a lot of different things here, and which of those entity structures would be best for you is going to be a very individual question. So as part of this, we offer a free 30-minute consultation with our entity development specialist, Raven Johnson. And she's able to speak with you for about half an hour, feel out where things are at for you, get an idea of just what your situation is, and based on that, make a recommendation. And she very well may recommend that you simply not form an entity at this point. The reason we offer this is both because I've covered a lot of information, and it's pretty technical, but almost more importantly to us, to make sure that you're in the right situation where we can actually help you and help you save on taxes. So if you'd like to schedule this consultation, give us a call, send us an email, or leave your information in that question comment box, and we'll be able to get in touch and get that scheduled in the next day or 2. So today, we ran over a lot of information, but the highlights, the very important things to take away are that first and foremost, in the eyes of the IRS, you are considered an investor until you prove otherwise. So as an investor, you have to really worry about the way the tax code is going to treat you. You have to worry about having wash sales, making sure those are calculated and reported properly. You have to worry about the effects of that $3,000 capital loss limitation stopping you from deducting your trading losses. You have to worry about the fact that your deductions are so severely limited. You have to worry about the complicated filing requirements of Schedule D. And so if you are trading as an investor, please make sure that your trading is being reported properly and that you're deducting those expenses that are available to you. It's only through affirmative actions that you can escape that investor tax status. The easiest and clearest affirmative step you can take is by trading through a formal business entity. By doing so, you can free yourself from the effects of the wash sale rule and that $3,000 capital loss limitation. You can remove the limitations from your deductions, and you can take advantage of the perks of operating a small business.